Hello, this is Voices of Impact. Trish from Verod Capital. Today I have my guest with me, Oguche. Oguche, would you like to introduce yourself?
My name is Agudah. I'm currently the Chief Executive Officer of the Pension Fund Operators Association of Nigeria, which is the umbrella body for pension funds in Nigeria.
Excellent. So, Oguche, we just got off a really interesting panel that was speaking about how fund managers and entrepreneurs can raise capital from providers of capital such as yourselves. Now, a couple of things that I thought were really interesting was the how to raise capital section, specifically, what does it mean to raise funds successfully? So maybe you can start off by sharing some of your comments on that. What makes you say yes to a pitch or to a fund manager?
I think from a fund manager point of view, it's really the dynamics of the team managing the fund, the founders. What's been their experience like as fund managers, whether with the current fund or with previous funds? What's been their experience in the industry? Um, that's very important. You want someone who's already been in that industry that they are investing in or understands the industry. You're also looking at the chemistry between the founders and co-founders. How many of them are there? Is there a balance from an operational, from a fundraising point of view? Is there a balance? And I think just their history. So just going into their history. I mean, we've heard stories of people even just checking on primary school, secondary school,
Yeah.
social media posts, just to know the person. Because, like I said, you typically back the rider, not the horse. So you want to be sure about the riders, their team, their experience, their dynamics. Really important about the founders.
And that's right. And I think in our experience as well, investing in deals directly, we found that that's also very key because there's one thing that they tell you, which is a story,
Yes.
but you know that the biggest thing is execution. And so you need to make sure that you're backing the right person and the right team that's able to execute on that.
Very true.
Another point that came up was a little bit of that tension between balancing impact and then balancing commercial returns. How do you think about your approach to that? How do you balance those two?
Yeah, I think, especially in Africa, most investments in the real sector, I would argue, can be termed as impact. Whether you are investing to expand a plant, when you expand a plant, the business does more, hires more people. When you invest in a business, you are helping a founder to sort of perpetuate a legacy, um, and there's family involved. So you're hiring more people, you're feeding more people. So that's one layer, right? So I think we need to get more money to the real sector, the real economy, and alternatives. Most alternative investments are accretive in terms of impact, in my view, whether it's real estate, whether it's infrastructure, whether it's private equity investing in various sectors of the economy. I think that is impact. So I would like to broaden the definition. I know there's been talk about intentional, whether it's on the environment or social. So those also, we need to begin to factor that in. But commercial returns are very important because if institutional providers of capital are not making enough return for their retirees or their members, the pension system could collapse. The way the pension system is built, especially the defined contribution, you need to be able to earn enough returns to be able to return back to the contributors when they retire.
Right. You have a duty
Having
to
said
them.
that, and hence the tension. Having said that, people will argue that if I retire and there are no roles, there's no power, then what's the point? So I think the balance is to ensure that pension funds, institutional investors invest more in the real sector, hard assets, for a decent return. And I think with that, um, we can get both. both financial and social returns.
Right. And what are some of the risks that you see, and how can people manage or mitigate those risks when they're coming to you for pension fund allocations?
Well, in our economies, um, the trajectory is usually not linear.
Right.
There's a lot of uncertainty,
Yes.
whether it's with interest rates, exchange rates, devaluation, change in policy. So, in our economies in Africa, there's typically turmoil, upheaval economically. So, I think for me, it still goes back to that. How is the team able to manage that? Goes back to the team. Most very important. Goes back to the team. So if you've got the right team with the right balance, you've got people who are strong operationally, people who are willing to learn,
Yeah.
willing to pivot. That's very important. I'm sure you'll see that in your business when you invest directly in companies. In addition, I think that diversification is arguably the most important aspect in terms of risk management. Just ensuring that you diversify from a fund point of view, not just one fund manager.
Yeah.
Fund of funds help
Okay.
in that diversification. Fund of funds help, and because you get exposure to various strategies, whether in terms of stages and various industries. So diversification is one key risk management tool that I think institutional investors, pension funds can use to diversify risk, particularly in Africa. But also just coming back to that, the team and the those that are running the fund or the business.
Yeah. And I think what you said there is absolutely key, right? Just having a team that's adaptable, because we've seen a lot of that. No one ever knows what's going to happen. You can make your best plans,
Yeah.
but nothing ever goes according to plan. So having a team that's aware, that's monitoring, and that's adaptable and can respond to some of these
Yeah.
risks on the horizon is absolutely key. Now let's maybe switch to some of the things that are absolute deal killers for you. Um, what do you see that makes you say that deck is going into the bin?
Um, I like businesses, individuals who've done their homework. So when I see someone who hasn't done his homework, it's a dampener, for me. Especially when you're fundraising, you need to understand who you are trying to raise money from, understand the sectors that they are playing in, understand who they've raised money from before. Even helps in the conversation. It helps to make, you can refer to, oh, I saw you guys did this. I see you guys are doing this. I see someone has left your team. So, sometimes you meet people and they haven't even gone to your website. That's a dampener. You didn't take the time. If you're looking to raise money, you need to understand who you're looking to raise money from, the industry you're looking to raise money from. In addition, you, someone that doesn't understand their own industry. So if I'm investing in you, lending to you, either as a fund manager or as a business, and you don't understand your own industry, it's a dampener.
Right.
You need to be so knowledgeable about your industry, your business, what you're doing, and that gives confidence to fund providers. It does so. If those are not there, then those are dampeners for me.
Well, Oguche, thank you for your time today and for the great conversation on the panel. And thank you all for watching Voices of Impact.